Good afternoon, everyone. How's everybody doing? Can you hear me okay? Sound is clear. Hey, Darcy, Greg, Ronnie, Raymond, Rob, Thomas, Bob, Mr. Wayne, Sean, yo, Keith. What's happening? Wonderful. All right, looks like we have pretty good turnout. Let me give it about a minute, and then I'll get started. Let everybody start trickling in here. How's your day today? Anybody trade? Volume's kind of low. I actually just got into a crude short a few minutes ago. Can't help myself. Right on. We too. Sure, Jordy. Jordy, that's you, right? George Douglas. Yeah. Yeah, sure. Let me do that in just a second. Give me 30 seconds and then we'll get started. I'll kind of start off with a little bit about where we are in development and all the breakthroughs that we've recently had in NinjaTrader 8 development. They've been pretty huge for us. So we've crossed some major hurdles recently over the past 2 weeks. And if you didn't get the email yet, we have new updates out as of this morning, as of about 4:30 this morning. So yeah, all the tools have been updated. Okay, give me about 30 seconds, and we'll get going. Okay. Whew, sorry, let me catch my breath real quick. Yeah, I guess we've had about 20 other people join since I stepped away for a second. So that's good. Oh, wow. Let me catch my breath for 1 second. Haneke, let me see. I think the time frame tuner is the same. So when we use something called Microsoft DevOps for our development. So anytime we make new installers, it basically just rebuilds everything, and then I just upload all of them all at once. So if the version number is exactly the same, then nothing's changed. There was one change in the master suite though, with one of the DLL version numbers inside of the installer. So I think there was a previous 8.1.6, and it had the previous version number for the volume analyst. And that was corrected in the one today. Sorry, that was 8.15. The one today actually has some fixes for a little bit more stability with the toolbar. So, whew, all right. I think I'm finally catching my breath here. So today is going to be really more for those of you that aren't really familiar with what we do and how we trade and all the tools that we have been developing over the years. So if you're already a member and you've been using the tools for a while, this will be pretty much just totally redundant for you. Although I am today going into a lot of the history of kind of what all has gone into the development of the methods, and discussing some of the history of the actual methods themselves and the pioneers of those methods, and then how I've combined them all together into our trading methodology. So I'm going to go into the details of that, and we'll be discussing some of the great figures in technical analysis. There are a number that we could talk about, but we've elected to only talk about those for whom we could actually prove a track record that they've actually made money, most of which have either worked at firms successfully, with pretty awesome returns, or they are, still currently working at some firm, some of which are trading, hundreds of millions, several billion. Excuse me. Yeah, Ronnie, this is being recorded now. We should have it up here by the end of today. And then we're going to do a part 2 on Saturday. So today I'm going to be doing, well, let me do this before we actually jump right into it. I'm so informal with all of this that I just kind of do everything extemporaneously, but here, let me do like I'm supposed to. All right, so before we begin, obviously trading is one of the most difficult businesses in the world, if not the most. And it's very, very easy to lose your entire trading account and even more. So, if you're getting into this thinking that you're going to be able to make really awesome returns, and you're going to be one of the top 1% that actually makes it happen, and you're going to do that to the point that you're going to be making hundreds of percent return per year, you should really, really think again. It's incredibly difficult and very easy to lose everything you own. All right, so with all that said, let's jump into this. And then Jordy, once I get through this, we'll discuss the recent advancements we've had in the tools. All right, so like I said, for those of you that have been with us for a while, this is going to be old news for you, but for those of you that don't know very much about us, I at least want to give you some background on myself. I'm going to try to keep that as short as possible. I don't exactly enjoy talking about myself, so hopefully we'll get through that in about 5 minutes. And then we're going to go into the background of the methods that we use. And Elliott wave principle, it seems to have a really negative connotation associated with it for many, at least the ones that are vocal. And I think the ones that tend to have negative views tend to be more vocal. So I've just heard several of our members express that, they haven't had very much success with Elliott because, the subjectivity of it or whatever. And I would say, well, it's one of the most difficult things to learn and apply properly. And although some people will say, you put 10 Elliotticians in a room together and they'll all 10 have a different take on what's coming up next in, whatever market they're looking at. And while that may be true, the fact is that one of them is always going to have the proper count given the context. So Elliott wave is, I'll kind of get into it a little bit and describe, what it's all about and why it's useful. But it can be misapplied very, very easily. And there's always the most probable count, which should be your preferred count. And then there's the secondary. So knowing which one should be your preferred count actually takes quite a bit of work and knowledge, and not just understanding the rules, but also the guidelines and what's more likely to happen with alternation and fib extensions and the ratios between the waves and whatnot. So while some of you may see this and immediately cringe, we're going to go through several people that not only affirm its validity, but that they also use it in their own trading. And some of these guys are trading hundreds of billions. It's not hundreds, sorry, hundreds of millions and several billions. So then market geometry, which is really the backbone to our methodology. And with that, the toolbar that we've developed and then the volume analysis, which is key to confirming the areas that we're trading, as is divergence analysis. And we'll go over the background of all of that. And then at the end, we'll wrap this up. I'll tell you about the deal we're going to have over the next several days into Sunday night. And before that, however, on Saturday, we're going to have a part 2 where I'm going to focus on purely nothing but trade setups, examples. I'm going to show you how all this works in real time using market replay, and how we piece all of this together, all the breakthroughs we've recently had in our tools and new features that we have for making all of this analysis as efficient and easy to apply as possible. So everything that we've done over the years has been, well, not only to make my trading, to facilitate my trading and make it, make my time, the use of my time, as efficient as possible, because applying the analysis that we're going to run through today can be quite time consuming. Not to mention, it's a little heady. So it can be a little tiresome if you're doing it manually by hand. And what I've been striving to do is to make it as efficient, as automated as possible, so that we can do this style of analysis, not just for swing trading, but also for intraday trading. And to do this for intraday trading, you got to have something fast and be able to apply it fast. And, we're going to go through some things that may seem a little daunting to some of you that are new, especially if you're brand new to trading in general. And you may think, well, how am I going to get the hang of this? This is way over my head. This is clearly, rocket science for trading. This is above and beyond what I'm capable of handling right now. What's in it for me? How can I benefit from this? So we've been working over the past, I guess it's about 3.5 years, but we've been working on a way to take all of the analysis that I'm doing throughout the morning. So I'm running the trading room for about 3 to 3.5 hours a day. And with all the analysis that I'm marking up on my charts, whether it be market geometry, trend channels, median lines, volume profiles, which we'll get into later, Elliott wave, I wanted to be able to export that so that those of you that are, a part of the group would be able to get that directly to your charts without having to apply it yourself. Because in the trading room, we're moving so quickly, and the focus is really all about finding setups that, to do the analysis, take screenshots, paste it into the chat, and then discuss it. It's just way too time consuming. So I wanted to be able to make this accessible to anyone, even if you have no idea what a hotkey is, or you're not very good with computers, whatever. So everything that I'm doing is easily exported to a server just by a simple press of a hotkey for me. So when I'm done with a chart, I hit a hotkey, it goes to the server, and then anyone that is registered on that server will then get all of my analysis directly on their charts within about 3 seconds, typically. And for those of you that are actually going to join with us here over the next few days, you're going to have the first 3 months at no extra cost. So I think you'll find it's going to be a game changer for you. So just real quick, I got started just right out of college, essentially in 2007. Went to school in Paris, and one of my best friends over there, Gonzalo, he's from Ecuador and from a very, very wealthy family, he and his wife. And he offered me a job to go work for him and his family in Ecuador, under the auspices that I was going to be actually doing real estate development, like Habitat for Humanity type housing and housing for the rich as well. And so that's why I accepted. And then when I moved there, he's like, look, we've got a change of plans. I want you to work with this little private equity firm that they had. And I want you to figure out how to get better returns than they've been getting. And they were already getting pretty consistent, between 8 and 15% a year for over a decade. So, I mean, they already had pretty awesome results. But he wanted to do better, and he wanted me to figure out how to do basically automated trading. And I had no idea what any of this was all about. But he knew that I was a good student because I had helped him through some courses in college. I was a teacher's aide for one of the classes that he was in with me, and then that's kind of how we became friends. But long story short, took the job. He paid for me to learn pretty much anything I could get my hands on, paid for all these different systems and courses. I ate it up. He put in a bunch of money, and needless to say, we lost every single penny because neither of us had any idea what we were doing. However, the guys that had already been doing well did, and they were using Wyckoff, which we'll get into in a moment, which is essentially, he's the father of volume analysis, Richard Wyckoff. And he also did a lot of work on price patterns in relation to volume. And that's really what all of this is about. That's what we're all attempting to do, is identify particular patterns, and then hopefully, if they're patterns that recur with any probability greater than 0.5, then they're potentially opportunistic patterns. In other words, you can potentially make money off of them if they recur in such a way that you can stack the odds in your favor. So that's what we're all about. That's what we're all trying to do. The problem is most of us are using indicators that are basically useless, and we see what we think are recurring patterns, but are in fact, they are recurring patterns, but they're just not profitable patterns. They're random patterns. And most of that's just a simple function of the look back. But anyhow, let me get back on track here. So by the end of 2009, the market had gone straight down 50% over a year and a half, and last in, first out. So I was sent home packing 2009, but I kept on because I was so fascinated with this stuff. And, I wasn't used to failure. As arrogant as I was, I thought, I'm not going to let this get the best of me. I'm going to figure this stuff out, and I'm going to make it work. So I dedicated myself to doing that. And yeah, it was basically pure obsession. But at any rate, I wanted to be able to program my own strategies and test them and actually prove out that what I was doing was useful and valid. And I didn't know how to program. I thought about learning how to program, but you're talking years of dedicated hard work, which I didn't want to have to do. So I found Bloodhound at Shark Indicators, which allows you to do visual programming. And within 6 months, I ate up every single piece of content that they had put out, every single training session that they had. And by the end of that year, I was offering a service to those that own Bloodhound. And within a couple of years after that, I think I'd worked with well over a couple of hundred different traders and built just as many custom trading systems using Bloodhound. Now, granted, it may not be as advanced as you could do with raw code, obviously, but it's still pretty elaborate what you can put together with a visual programming tool like Bloodhound. And then through all of that, I was able to determine what was useless, which most of it was. Well over 90% was just, basically variations on the same theme. I could tell that just about everyone that I had worked with had been reading Stocks and Commodities magazine. They've read all the technical analysis books that I've read, and they had all the same ideas that most of us have. And the vast majority of that just simply does not work. So I wanted to figure out, well, what does work? And then I started thinking about, well, the guys in Ecuador that were actually doing this consistently, although they weren't, in my imagination, 10% seemed mediocre. Now I know better. But still, a consistent 10%, 12%, 8% per year, that's saying something. So they were doing kind of a form of market geometry aside from median lines, what some people would call pitchforks. They were using trend channels and Wyckoff analysis. So I started digging back into that, and I started developing the prototype to this toolbar to help me apply the trend channels and median lines much more rapidly. And then I went down the road of relative volume, which was really the key to this whole thing. And we'll get into that in a moment. But I had to hire a programmer full-time to make this work. And so I did. And, full-time programmer, you're talking quite a bit of money. So yeah, within just a couple of years, needless to say, I needed to raise some money. So I began to market the tools that I recently developed. And that's kind of what I've been doing ever since, paying for all of the development costs via the occasional webinar that we do, which we're doing now. And I'm already 30 minutes into it, and I'm not even through the introduction. So that's the gist of me and a brief history of the company. Now the method. So number one, I knew that there was clearly something to trend channels. I mean, it doesn't take a genius with very much time to figure out that the markets do tend to conform to these kind of channeling patterns. And it's much more precise than you might even think, but we'll go over some examples today, maybe just a few. On Saturday, we're going to go over dozens and dozens. All right. Now, I got into the Elliott wave theory. Can't remember exactly how I got turned on to that. I think it was one of the courses I had done, and a platform that I had bought. I think it was like L Wave or something like that years and years ago, which was kind of mediocre at best. But anyhow, I started learning Elliott wave theory and researched it as well as anybody could. And it made sense to me because you're actually taking into account that the markets are made out of people changing. Essentially, the markets reflect social mood. And I don't know if you guys have ever heard of the book something in the Madness of Crowds. I can't remember the name of that guy or the exact name of the book, but I think it was written in the 1800s. And he goes into kind of the herd mentality, how people tend to react differently in a group environment than they do otherwise. And how that applies to the markets is pretty extraordinary, actually. So Elliott, and I'll give you a little bit of background on him, but I'm going to have to fly through some of this stuff. Elliott spent quite a long time going through about 75 years worth of data, trying to glean from it these recurring patterns that we're all looking for. That's what we're all trying to do, make money from recurring patterns that we think provide an edge. Whether that be just a simple crossover in one of your oscillators or a moving average or whatever, it all boils down to pattern recognition. So in the context of Elliott wave theory, you're going into why the market moves the way that it does. And I won't go into all the details of it, but it makes sense. And then when you see example after example after example, you can convince yourself that there's something to it. All right. But then to prove it out, that it's either useful or not, is probably one of the most difficult things that you could do that I've ever done. And, I know for sure that some people would argue with me and say that they've done the same thing and they proved that it doesn't work. And yet there are several people who use it and are consistent, high value hedge fund managers or some type of a fund manager that bring in massive amounts of money year after year. So the fact remains, there's some pretty brilliant people out there that use it and swear by it, and they make money. So maybe there is something to it. And those of you that have swept it under the rug or put it in the closet because it's piled on top of all the other things that you've bought and used and learned that don't make money, you might want to re-examine it. So what we're using Elliott Wave for is to simply identify the major overall trend and then the corrections within those trends. And it's really nothing more than that. You don't have to subscribe to the premise behind it, that the market moves the way it does because of human psychology and herd psychology at that. You don't really have to subscribe to any of that. The patterns that they've identified, that Ralph Nelson and Elliott initially identified, but then Robert Prechter and Frost and a few other guys really, really honed in and solidified like the main corrective type of patterns. Those corrective patterns, memorizing those, all the different variations of them, has been more valuable to me than just about any other thing. And then using that in conjunction with the market geometry to identify the exact areas where we want to enter the trade and then trade to, takes Elliott Wave and makes it into something that you can actually apply consistently, eliminate a little bit of the subjectivity from it, but not all. Okay, I know everybody wants to eliminate subjectivity, automate everything, but most of the people that I've spoken with or heard speak that manage funds or prop shops will all say they're discretionary traders. 9 times out of 10 will do, well, much more than that. I think they say about 98% will do way better than any automated system that they have. Most automated systems have a kind of threshold, especially when it comes to high frequency stuff. You can trade so many lots, but not more. Whereas a discretionary trader can do quite a bit more than an automated system. So, with all that said, the context from Elliott Wave and just trend and corrective patterns in general, we find the exact area that we want to do business at, that we want to enter the market, using market geometry and volume profile across different time frames. We'll get into that in a moment. And the key to this, in my mind, some people want to just use market geometry and volume profile by itself. That if you do that, you're at least on the right track. But then to make the trades that would be produced from those areas just using market geometry or volume profile alone will be much more, how do I say that? You'll have a higher percentage success rate when you incorporate volume and price action to confirm the exact area where we're trying to trade. Okay, so it's not enough that I have everything come together at the exact spot where I want to enter the market. I then have to have X, Y, and Z happen at that spot to confirm the entry. And when I'm talking about confirmation, I'm not talking about the market rejecting out of that area. I'm talking about a huge amount of volume coming in, relative volume. I'll have to discuss that in a little bit, but it's quite different than just raw volume. And I want to see on the faster time frames, I want to see price action slowing down into that area. It may look like a V bottom or a V top on the actual operative time frame that I'm trading from, but then I need to confirm that area using faster charts. than my operative time frame. So let's say if my operative time frame is a 15-minute chart, I then want to use the 5-minute, the 2-minute, and a couple of faster tick charts or these row bars that we've developed to then confirm those areas and actually see that loss of momentum into the area using our divergence analyst and then the high volume signals that we get from our volume analyst tool. All right, so I'm going to have to fly through this. Give me 1 second. Yeah, that's it, Tim. Extraordinary popular delusions and the madness of crowds, right? All right, so just real quick, guys, because I want to get into the meat of this. I know David's falling asleep here. So Ralph Nelson Elliott, he's the guy that came up with it. All right, I'm not going to go into too much detail about this, but the work that he did in his book, Nature's Law, was the foundation for Tom DeMark and then Robert Prechter and Robert Frost to then take the Elliott wave principle and hone it and kind of revamp it with thousands and thousands of charts and patterns that they then ran through some statistical analysis stuff that was available back in the 70s and 80s. So basically, Tom DeMark, he was working at Stephen A. Cohen of SAC. He was working for, special advisor to Stephen Cohen of SAC Capital. And he was also a former executive vice president to Tudor Investments. You guys know Paul Tudor Jones, I'm sure. He's one of the most successful hedge fund managers of all time. So Tom DeMark, he's basically consulted for everybody. So he was actually the guy that took Ralph Nelson Elliott's work and brought it to this firm. So he gave the book to a guy at Merrill Lynch, the chief market strategist there, Bob Farrell. All right. And then actually it was Robert Prechter that then went to work for Merrill Lynch and that guy. And he got the book from Robert Farrell and became intrigued by it. And then the rest is history. He then looked up Robert Frost, and then they teamed up and wrote that Elliott Wave Principle book and did all the statistical analysis for all the different patterns and corrective patterns. And he actually went on, believe it or not, and this is very well documented, he went on through the 80s to have some of the most just ridiculous market calls. Basically, no one's ever come close to that. I think it was about 15 to 20 year run of just perfect projection month after month after month. I mean, he was considered, one of the rock stars of the analytics community. And that's how Paul Tudor Jones found him and his work. And Paul Tudor Jones basically says that it's Prechter's work that really put him into a new class of thinking in terms purely of risk to reward and maximizing your reward per the risk that you have on. And that's what we're all about. We're all about maximizing the return per the risk. All the trades that we're looking for are high R multiple trades. And using these corrective patterns does make that much, much easier. So Paul Tudor Jones is quoted as saying, Elliott wave theory allows one to create incredibly favorable risk to reward opportunities. And that is really the reason I attribute all of my own success to the Elliott wave approach. So there's all kinds of examples of people similar to that have made such statements, but we wanted to use, only people we could prove have made money consistently. So just real quick, Elliott wave principle, it's all about looking for impulse and correction. Impulsive moves within a trend corrections within the counter trend. So we're looking for fives and threes and fives. Impulses move in 5 waves, corrections move in 3 waves or sets of 3 waves. And being able to identify these corrective patterns is really key to what we do. And when you combine this with market geometry, it's just it's crazy the kind of calls you can make. So how are you guys doing? Are you following me here? Anybody falling asleep yet? You with me? A little? All right, I'm going to get on with it. I know a lot of you guys have been, you've been through all this stuff. You want to see some trades, man. You want to see some trades. So we'll get to that here in a minute. This is one trade that I did take, actually. So what we're doing, with the Elliott wave, we're identifying the key trend, and we're using multiple charts to do this. So it may seem overwhelming when you first download the software and you install everything, because you have, I think it's about 9 to 11 charts on a single workspace. But some of those charts are, a 4-hour chart, a daily chart that you may rarely use, but still it can seem a little bit overwhelming. So we use these multiple time frames, not to overwhelm you and confuse you, but because there's a degree of randomness, it's basically where the randomness comes in to the sample size, to the actual chart period and type, even whether you're using a time-based chart or a tick-based chart or some hybrid of the two, or even range type charts. There's so many different variables that go into the sampling of the data that you're looking at, that it does introduce a degree of randomness to data that is potentially already fairly random. I say it's fairly random because there's quite a lot of studies that have recently come out over the past 6 or 7 years that are kind of proving another school of thought, that it's not random per se, but chaotic. I'm not going to get into all that, but there is a degree of projectability with chaotic type systems as opposed to purely random systems. If price action were purely random, would anyone be able to make money consistently? Trading using technical analysis, would it even be possible? Well, the answer is no. It would absolutely be not possible. It would be impossible. There would have to be some level of predictability within the price data to afford anyone the ability to make money from trading. So the fact that people do make money consistently, and the guys that we've touched on briefly, and we'll touch on some more, have all done so with extraordinary results. So what you're seeing here is an impulsive move up. Let me use this. All right, that's your first little impulse there. And then a tiny little correction on a much smaller chart. So that would look like a trade setup on the 2-minute at that low, but this is a 15-minute chart. And then we have the third wave impulse, which subdivides. And then we have the big fourth wave correction, and all of these waves are overlapping. Most of the corrections will tend to trace out channels or within median lines. Channels are just simply drawing a trend line from high to high, in this case, because it's downsloping from high to high, and then doing a parallel from that subsequent low. And then we're looking for when the market comes back down to the bottom of that channel, in line with, you can't see it on this chart, but maybe we'll get into the forum and I'll go through these one by one if we have time at the end. But you have that larger upsloping channel with its parallel coming in right there. So we actually have about, 5 or 6 areas coming together right at that exact low just on this one chart. So we're looking for at least 2 areas from the market geometry that come together. And I'll explain market geometry in a moment. But within the context of Elliott wave theory, okay? It doesn't have to be, totally rigid. You don't have to learn every single detail of Elliott wave theory, especially since I can export all this directly to your charts. But it would behoove you to actually learn the different corrective patterns, because learning those have really been key for me. So all comes together. We have the volume signals, which I'm not going to go into just yet, and then momentum divergence on the faster charts. We even have it on the actual operative time frame chart here, which is double momentum divergence, if you can see it. And I'll go into that later, and then there's the result out of that low. So we have a forum where we're taking screenshots of every single trade, not necessarily every single trade, but every single chart that I mark up, and then export an image of that will go directly to our forum, so that anyone that's actually signed up for the service, and we're still trying to make this pretty. It's pretty ugly, but we're working on it. So everything that I'm doing in the mornings and now throughout the afternoon, starting next week, will be exported to this forum as it's being imported directly to your chart. So whoever signed up for it, you'll get the objects directly to your chart, and then a copy of the screenshots of the forum. And you can go back and see, how it worked out after the fact, or what we were doing before that major turning point occurred, and learn, to some degree that way. So this is just one example of a corrective pattern coming together with that established and previously identified trend with the bottom of the channel. Bigger channel sloping in favor of the trade, smaller channel sloping against the trade. So the bigger channel sloping up, smaller channel sloping down. It all comes together right there for the exact entry, for the exact price and time where I want to initiate my entry. Okay, and then we're looking for the volume to confirm that area. All right, so now a little bit about the market geometry. So basically let me just put it like this. I have a lot of hand-drawn charts that I don't know where I got them. I think I ordered them off the internet a long time ago. But they're hand-drawn charts from the 1800s. So I think they're about 1880, 1890. And they actually have trend channels that were drawn on them. So just a normal trend line from low to low and an uptrend, and then a parallel of that from one of the subsequent major highs. And then it shows the market tracing beautiful waves out back and forth within that channel. And it's all hand-drawn, late 1800s. All right. This guy, Roger Babson, who is recorded as having made just an absurd amount of money. I think it's let me just see here. He took 1,200 into several million, and that he went on to make about 50 million in his lifetime. So back then, I think that was the 20s, 10s and 20s and 30s. I'm sorry, it was just before that. Yeah. So it was the first 10, 20 years of the start of the 19th century, or 20th century rather. So yeah, he was on to quite a bit nuanced type stuff, like action reaction lines, which is a little bit different than what we're doing, quite a bit different actually. But he provided the inspiration, I guess you could say, for Alan Andrews. And Alan Andrews is the father of the pitchfork, what should be named the Andrews median line. In a lot of platforms, it is called Andrews median lines, but other platforms will just simply call it a pitchfork. So Alan Andrews took the idea from Babson, the whole action reaction type thing, and rather than just using a simple trend channel, he used what's called a median line, where I'll show you some examples here in a minute, but it just provides a different type of area to use as the expected target for the next move. Okay. And it goes way deeper than that. It's actually pretty crazy how some of this stuff lines up. So you all know about, and this is probably the most common thing that's taught when it comes to supply and demand. People will talk about, oh, well, you had supply come in here, so that must mean there's still some supply sitting there at that area. So when it comes back up to that area, well, it's likely to turn down from there again. When you see double tops all over the place, they're so easy to pick out because you have two swings that turn from the exact same price or pretty close to the exact same price. So it looks like, well, wow, double tops, double bottoms, that's got to be a pretty easy thing to trade. Well, think of all the double tops and double bottoms that fail. Every single move through a swing is a failed double top or double bottom. So I think it's one of the most, it's just not fully understood by people how the failure rate of this is so overwhelming that it's almost impossible to be consistent trading double tops or double bottom. But nonetheless, people teach this. So this is kind of a rudimentary type of example of, you could say, market geometry. It's really just a horizontal line from the previous swing high. So we can take that one step further and kind of get a little bit closer to the idea of market geometry and draw a trend line from high to high. Excuse me. You can see, well, didn't really do you much good for that next lower high there. And then it comes right back down. We haven't obviously made it back to it, but what if we then take a parallel of that and draw it from here? This is the kind of thing that you'll see over and over and over on a daily basis, just drawing simple trend channels. And you could do it yourself using NinjaTrader's tools, drawing tools. But if you really want to do it with exceptional speed, you can use our toolbar to do it. Now, the median lines are a little bit different. Okay, and our tool will draw both trend channels and median lines at the same time, which makes it just makes it dramatically more efficient to do this type of analysis. But a median line is essentially taking that, well, let me draw it like so. Taking the line from that second click of the initial baseline and then drawing it to the starting point of the parallel. And then you're finding the midpoint of that. And then you're drawing from the first click or first swing, start bar of the baseline through that midpoint. That's not really a straight line, but then you've got your median line set. And then you do a parallel from the second click or the end bar and a parallel from the lower part. Now that's pretty rough looking, but that's the idea behind median lines. So we're actually drawing both of those at the same time with our toolbar, And then there's a million other things you can do with this thing. It's actually pretty incredible what we put together. So if you guys know that NinjaTrader has order flow tools built in now, and it even has volume profile and range select volume profile, so you can actually draw volume profiles on any swing. You can start it from any bar, draw it all the way past the current bar, or draw it for a specific swing, and all that. But you have to own the platform or lease it. So we have a pretty incredible volume profile that's probably the most efficient one that's been made for the platform yet, just because of everything we had to go through in NinjaTrader 7 to make it work. We, obviously ported all that over to NT8 to make it as efficient as possible. So that's this portion here. Now let me just briefly explain this for the sake of time. I'm already at an hour now. Hopefully you guys don't mind. I guess you're sticking around for now anyway. This is the main panel of the toolbar. Let me see if I got an actual straight line. I don't think I do. I'll just use the pointer. So this is the main toolbar. And what we did in this most recent version, which some of you guys have had for a month or so, or two, we added what are called grouped buttons. So each one of these on this main toolbar panel is actually a button that opens up another toolbar panel with a group of buttons. All right, so for instance, this one here is the market geometry group button. And when you click on that, it opens up this one, this group. And I've got, as you can see, 8 different layouts for this market geometry button. And I'm drawing both trend channels, median lines, all their warning lines. The lingo may sound a little bit awkward to you if you're hearing all this for the first time, but it's it's something you'll pick up on pretty quickly. But to be able to draw both at the same time without having to fumble around with Ninja's drawing tools that sometimes snap to the right bar, sometimes not. The snapping mechanism that we built out makes it to where if you're zoomed all the way out and you can see the most bars possible on the chart, it will still snap to the swing point. So it'll find the lowest low of the past 7 bars to the left and then 7 bars to the right. And you don't have to be so precise when you're drawing this stuff. You can just point and click and you're good to go. And all of this, by the way, is controlled by hotkeys if you so desire. So we can use hotkeys to actually snap the group toolbars directly underneath your cursor, and then you can just click on the button that you want to draw. Or you can use hotkeys for the individual buttons themselves. And this is the most elaborate version to date, and it makes performing this type of analysis so incredibly fast that it's pretty amazing. It amazes me, and I use it every day. So these are the types of channels and median lines I'm talking about. All I've done here, I've connected from low to low. It automatically finds that swing high, draws the upper median line there. This is the parallel of the channel, parallel the baseline. All right, that's the actual median line. You could say the center median line, I guess. That's a little redundant, but this is the parallel, lower parallel from that end bar of the baseline. And can you see how the market seems to conform to that? It may only be for the first few swing points, and then it puts in a new slope. But the market, and this is pretty easy to prove to yourself, guys. You don't need me to try to convince you of this. You can just go and use, a 5-minute chart, a 15-minute chart, and some tick charts. Don't use Renko bars, don't use range bars. It might by chance line up perfectly on some of those, but use tick charts and minute charts and just start marking them up. Draw from the most obvious swing highs and lows, and within about an hour, you'll start seeing like, this is pretty interesting. Why has nobody told me about this before? It's very, very easy to prove this to yourself. So this is what we mean by identifying the exact area where we want to do business. Where do we want to place the next trade while taking into account, while taking into account the context, the overall trend, especially of the higher time frame and the position within the Elliott waves. So one of the things that we look at when it comes to Elliott wave, there are several different rules for identifying, where is the most likely location for the end of the fifth wave? Where is the most likely location for the end of the fourth wave? A lot of trades that I've taken or actually missed because they occurred at about 2 a.m. or 3 a.m. in the morning have been fourth wave lows, and especially in the S&P 500. So let me just show you this real quick. This will be, I didn't plan on this, but it's kind of how it goes with me. All right, so I can just hide everything just by using a hotkey. I can snap this right underneath my cursor using another hotkey. I've got a little keypad here, a little gaming keyboard, and it takes about a week or so to get used to it. But once you have everything programmed out within that little keyboard, you'd be amazed how fast you can start drawing with this stuff. So let's see, we've got a little marking up we want to do. Let's say we want to do 1, 2. Now we're looking at that big push up. I don't think we've made the third wave high yet. I'm thinking the third wave high is about right there. And then we're looking for a fourth wave correction. I am on the right chart, by the way, right? You guys can see this properly? Okay, good. All right, so I'm looking for back here, and I'll show you this on the forum. I'm looking for where this next retracement low is going to be. And I'm thinking, kind of had to rethink this a couple of times because we had some areas that came in at these highs, and I was thinking we were going to get a little bit deeper correction, something similar to this. And then it only gave us these little corrections and then broke right through. So rethinking this, I'm moving into this thought pattern here. I'm looking at that as a fourth wave triangle. And then I'm looking for, sorry, that's the smaller third wave of 1 less degree. This is what I was doing here. And this, you get the idea as to where the likely end of a particular wave will be based on the Fibonacci ratios, based on the size of the preceding waves leading into the next subsequent wave. So I know this seems like hocus pocus to many people, but join us for a little while and see what you think after a few months. All right, so we've just found that high there. And now we're looking to identify where the end of that fourth wave is going to come in. And so what is the rule? What is the main guideline? It's not a hard and fast rule, it's a guideline. How do you find the end of that fourth wave? All of you guys that have been in the room for a while know. Without a doubt, you must know. Draw from 1 to 3, parallel from 2. And this is something you don't get from Elliott wave because they don't use median lines, they just use channels. But typically it's where that center median line is going to intersect the channel. So in Elliott, they would just say the bottom of the channel. All right, but what we're doing with market geometry is more along the lines of what Gann was up to, what he was talking about until he went crazy from syphilis. He started writing about nonsense. What he was talking about was combining time and price and doing projections for where the next swing high or low would be, not just the price of it, but in time. And that's really what market geometry is all about. This is supply and demand using the previous major swing highs and lows, and then projecting forward a function of those previous major swing highs and lows so that you can anticipate where that next major area of supply and demand will come in the future. And that's really what this is all about. Most people would say, especially the academics, that you can't do that. You can't anticipate price action because it's random. But I assure you, you can. You're not going to be 100% successful, but really all you have to have is a probability of 0.51 or greater to potentially make money. You also have to have pretty awesome risk control to make that work. But at any rate, this is what we were looking for the fourth wave low back here. And then we come down, we make that fourth wave low, it goes sideways a little bit, and then the target is then up in here at about 3160. And we're almost there. So in real time, let me just show you what that looks like when I'm doing all this in real time and then exporting it to everyone. Excuse me. Let's find it. It's coming. It's right after this one, shortly after this one. Yeah, that was the first trade that we talked about. That was the one I actually bought, and then I just got out right there. Let me see. I think I have it in Slack right here. This is it. Because back here, I was actually looking for a bit more major of a high in here. And we did get a couple of longs into that. But then I was thinking, well, I'm not going to take the next long because it's probably going into a lower high. And then I want to see what happens. So I want to see if maybe I can catch that lower high or wait for it to occur and then change trend to the downside and then look for the next short. But then overnight, and this is something I'll be doing much more frequently here in the future, ahead of the next day's trading session, so that we're all prepared for it. I spent about a half hour on this and tried to figure out, well, what is the most likely scenario here based on the size of this first wave up, second wave back down, and then this pretty fast and sharp first wave up. I'm not really finding a fourth wave in here that's relative to this wave two. And now I know I'm getting over the head of many of you, but these are the things you have to think about when you're applying this type of analysis. So at this point, I'm thinking, well, the thing is, it's just that all of this is tracing out 1 degree lesser than this degree. All right, so this is a larger 1 and a 2. And even though this in price might be about the same size as that previous wave 1, it's all within 1 lesser degree. All right, so this big one is a larger wave per the degree system, the way it works. It's kind of fractal in nature. Then this 1 within the circle, it's Roman numeral I. So I'm thinking, okay, well, then we've just finished up the third wave of this larger set of five. So I'm actually looking for a fourth wave of one lesser degree. I'm not looking for it to come all the way down. And the most likely spot where that's going to put in is at that parallel where the median line intersects it. So that has a much higher probability of being where it's going to turn out from and reinitiate the trend. And then this would be the second most likely, and then third down here. But this is much more probable just based on the statistics of what Prechter and Frost proved out, where that fourth wave will actually put in the low. And then lo and behold, that's what it did. So let me show you where I actually made it abundantly clear here. So we had been using Slack up into this point. We've been trying to move over to this forum. And then now starting Monday, we'll be officially on the forum only, and Slack will be done away with. So when we actually did come down to it, and that was in the middle of the night right there, I think it was about midnight. Okay, then we turned out of it a little bit, and I went ahead and posted this and sent out an export, making sure that everyone had it so that I had to take that next morning off. I wanted them to have this as being the next target for that fifth wave up, which was just shy of 3160. And now, where are we? I mean, this is just one example, but it's the most recent example. I'm taking the most recent example I have to show you. It could have been a loser. It could have been wrong. It just, it's not. So hopefully that's worth a little something. That's up to you, though. One of the things with these median lines is that they tend to move from, if you reject from the center median line, you tend to move, well, obviously, if you're rejecting up, then you'd move to the upper. All right, we just hit that today. So that is the first spot where you would look for a potential exit. Being that you turned up from the center median line, exactly where it intersects the parallel channel, that is your initial target. And you hadn't hit it yet until just today at the close. So I would be out right there. I wouldn't wait for 3160. I'd be out right there. I didn't buy it because what was I doing? I think I was in the hospital, not in the hospital, but doing some tests for my heart. So I missed this trade in here. But, that would have been one you would have had to have held for a swing trade. All right, so how do we confirm those areas? Let's see. I'm about an hour and 15 minutes into it. You guys want to go on? You want to keep going? Of course you do. If you're anything like me, you don't want to do anything other than this. All right, just a few more examples here of some trend channels. And these are just kind of random examples. I had Josh put these together just quickly. He just, picked a chart and drew on it, and there you go. You got some, you can do this for just about any chart. And it's just example after example after example, high to high. You go right down, in this case, through that channel, but it's an upsloping channel. And this is a particular type of pattern. This is what's called a flat correction. So you got the big A wave down, B wave back up. It's an expanded flat, breaks that high, and then 5 waves down into that final low, rejected up from the lower median line, and then you can see what happened thereafter. This is a nice one here. This is the kind of thing that I seek out. What looks even better is when you actually have a smaller channel that lines up. In this case, it wouldn't have, but it would have with the midline between those two. parallel lines there that I just drew. Not exactly parallel, but yeah. So if the position that it's in wouldn't make any sense to actually make it to the opposite channel, then your midline becomes the area of focus. These are all things that you'll learn once you start working with us in the trading room and get into some of the training sessions and whatnot. Now, volume analysis, we're going to have to get into some of this on Saturday, but let me just say this. What we've done with the relative volume is I don't think anyone will be able. That's not true. It took a lot of time and debugging to make it work, but we actually have relative volume for tick-based charts. Now, that may not sound like any major accomplishment to you if you don't know anything about what relative volume is, but let me give you a short, very brief primer on this, and then I'll just show you just a couple of random examples. Now, I got the idea, of course, I studied Wyckoff extensively. Everything I could find on him, I got a hold of. There are a number of people that have produced trading courses and indicators, all sorts of stuff. A lot of people have capitalized on the work of Mr. Richard Wyckoff, and you could say I have too, but I've taken it to the next level. I can't, I don't want to. So people can take a MACD and they can name it something else and call it the awesome oscillator. And then next thing you know, oh, this is the guy that made the awesome oscillator. When in fact, all it is a MACD with different values for the look back periods. That kind of thing is shameful to me. It's ridiculous. So if I'm going to use someone's methods, what else are you going to do in technical analysis? You've got time, price, volume, how you're going to display that data in a bar chart. You've only got so many things you can work with. Are you going to apply a bunch of crazy physics calculations to the price data? A lot of people do that and they claim it works, but then I've tested a lot of those systems and none of them have worked. So either I'm an idiot or that sort of thing is just foolish. Now then, you've got volume, which is what? You've got volume and price. Which one comes first? Volume, right? You've got to change hands of a contract to create a market. And then the price of that transaction is logged in the books and sent to everyone that's got a data feed. So the first thing that happens is a market is made, volume changes hands, that's recorded as a deal, a price, and a change in price if it moved the ticker. And people like to say, all these price action purists, guys that pride themselves on not using any indicators at all, and I used to be one of them. They like to say that, price is the first order indicator and all these other little oscillators and moving averages and blah, blah, blah. That's all second order stuff. Well, I would take it one step further and say, no, in fact, price is second order. First order is the changing hands of the contract. It's the volume, it's the market for that price, right? So think about that. It's the volume that actually creates the price. It's the volume that determines how far a price could possibly move. If somebody's coming in with 1 million contracts all at once, you might see price move 80, 150 ticks, right? So it's the volume that's the first order. So I just remember that from being in Ecuador. That's one of the things the guy would say. He's like, volume is really the key to all of this. But none of it works without some sort of context to put it in. So you can't, let me think of how I'm going to phrase this real quick. Yeah, I'll give you my thoughts on the volume profile. Volume profile is useful for sure, but in a certain way. So how do I say this without offending people? Anyway, I'll say it another way. So, okay, so you've got, let's say you've got a couple of indicators, right? Just whatever. You've got a stochastics, you've got an RSI. Somebody tells you that stochastics and the RSI are the end all be all. All you need to do is you need to take longs when the stochastics together with the RSI turns up from below 20. Done. That's when you buy. When both stochastics and RSI turn up from 20, and then you sell when both stochastics and RSI turn down from 80. Now imagine you did that on a 5-minute chart. The 15-minute chart is screaming to the upside in a big, massive uptrend, and you're buying it every time they both turn up from 20. And then you're selling it, and you're always in, always out. And you're selling it when they both turn down from 80. Do you think the trade's short when you're in an uptrend that's screaming to the upside on all the higher time frames? Do you think those will be more successful than the ones where you're actually buying long? Or do you think there's any correlation whatsoever? Will they both be equally as detrimental to your account? So I get in this talk with people all the time. Not all the time, but I mean, I've had this discussion a few different times. And they want to pick the methods apart. They want to take each one of them individually, and they want to make sure that each portion, each tool, each confirming tool for the volume, the divergence, and then the market geometry for defining the areas, and then using Elliott wave or just simple trend and pattern recognition for the context. They want to take each one of those individually and test each one individually to prove that the independent components work and are profitable. And then they'll have faith in the system, but not before. So do you see what I'm getting at? You can't take a confirming tool by itself and test it on its own and expect to prove that it's somehow going to be profitable on its own. It's a confirming tool. It's a piece of another system, right? And it's the last piece. So you wouldn't use the rules that you've defined for the confirmation of your areas that you're trading from within the context of the higher time frame trend, whichever chart you're trading. And I haven't gotten into all that yet. We'll get into that on Saturday. How do you define your operative time frame? And then which charts do you then use for confirmation? You can't take each individual component on its own and somehow prove the validity of the whole entire thing just based solely upon each individual component. Is that clear? Because I hear that come up, and it's you just can't think of it like that. That's not the way that it works. The volume and the divergence, the momentum divergence, are the final piece to confirming the trade after you've done step number 1 and number 2. Does that make sense? So don't think that you're gonna just get each individual tool and You may be able to take the volume, and you may be able to take the divergence and beef up some other system that you've been working on for a while. You're just missing that one component to help you identify when to take certain trades and when to not take others. That might be useful for you, but you're not going to just take and trade one single component all by itself and expect to make money, to even be consistent. Okay, it's all within context, and I'll show you example after example of this on Saturday. But when you're in a really strong uptrend, you're going to have volume signals at each bar's high all along the way, all the way up. You're going to have major volume signals all the way up, and you're going to think, well, this is just ridiculous. Why am I going to put any faith in this when I've got 30 failed signals just in the past 300 bars? Well, it's because you're not taking those signals. You're not shorting it at the high in a massively strong uptrend. You would expect to see that kind of behavior. You're looking to get into the ends of the pullbacks, and you're not going to take it unless you have these particular volume and momentum divergence signals. And then the final piece to that puzzle, knowing which ones to take and where and when, all boils down to how many bars make up, or how much time makes up that entire correction within the trend. If you're looking at a really fast chart that's been moving straight up, and then you've only got 10 bars that retrace down, just to draw it real quick. So let's say you're going up, 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 up. You got a little retracement there, up, 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 little retracement there. That's only 10 bars. You're not going to have this awesome volume signal at the end of that. If you do on that particular chart, then that's very significant. But rarely will you have a volume signal at the end of such a tiny retracement on that particular chart. Now, if you hone in on, if you zoom in on that, let's say this is a 15-minute. If you then looked at a 2-minute chart and it took up, what did I say? So 75 bars, then chances are you would very much likely have a major volume signal at the end of that corrective wave. Okay, so there's a lot of factors that play into this, and you'll learn some of that on Saturday. But for now, I'm running out of time. I'm going to wrap up here with volume and just go a little bit further about how I identified kind of the missing component to volume analysis, because I wanted to apply all of this to intraday analysis. I knew that applying volume analysis to daily charts, fairly straightforward. I mean, you really had to understand volume and volume per range, right? You wanted to look at not only the volume of each daily candle, but also the size of the range of that bar, that daily bar. Was it a, really tiny, narrow range bar, but on massive volume? Well, that's significant. That means that if it's at the end of an uptrend, well, that means that you've run into a brick wall of supply, and you've still got a huge amount of buying coming in, but yet the market is no longer moving up. It's just, standing still there, because a lot of people have come in, they're absorbing that buying, they're selling into it, they're unloading the longs that they've undoubtedly had for a while, and the public is then the ones that are buying as they're selling, right? Because that's what they tend to do. They tend to buy the highs and sell the lows. And I know it. I've done it. I've been there. But at any rate, so the problem with volume, yeah, it's all, pretty straightforward on a daily and a weekly chart, but then you get into intraday charts, and well, then you've got a major problem, don't you? Because you have seasonality within the session. You've got very high volume during the open, very high volume during the close, and in the something like the ES, you've got next to no volume in the overnight session, right? Very low volume. So that variance from one session to the next, and then the kind of seasonality within the day session, very high at the open, a lull at lunch, and then extremely high right at the close. Well, that makes using volume intraday just untenable. You can't use it effectively. So I'm going to explain this one concept to you, and that'll kind of set us up for where we're going to start on Saturday. So I want to make sure you understand this one concept and how important it actually is, because this is the next level in volume analysis. This is really where we've taken volume analysis to a new realm. Sounds pretty arrogant. It's pretty cool stuff. I think you'll agree. All right, so this is volume on a daily chart, right? Pretty straightforward. You don't really have the seasonality effect that you see within intraday data. However, you do with futures markets, because you tend to kind of, right at the end of the expiration, you get that dip. Like you can see it. That's probably one there. That's probably one here. It's probably one right there. So you do have that day or two just before expiration, or just before everybody completely moves over. Some people move over before the actual expiration date, and then you get this drop off in the volume. But aside from all that, it's pretty straightforward on a daily chart, without taking into account volume relative to the range of the bar, and then volume divided by the range of the bar. There's a lot of different signals we could talk about, and we'll do that on Saturday. But see, these are major spikes at these lows, right? Anytime you have a really sharp major turning point within just what you can see on this chart, you've got major high volume. I mean, it's at least one multiple of the average. So you would say that's about 200% of the average, right? And you tend to see that at major turning points, not just at lows, but especially at lows, more often at lows than at highs. Here, though, within intraday data, this is where we get into the problem. How are you going to compare the volume at the open to even the very next bar? I mean, you can do it, but is it going to make any sense? Is it going to be useful? Whatever you think you might glean from that? No, it's really not. I mean, this is a 15-minute chart. If you move down to about a 1-minute chart and you gave 10 minutes after the open before you started to use it, you could probably use it effectively for, the better part of the middle of the day, middle of the session, but not at the beginning, not at the close, and not at the change from overnight to open, and not at the change from close to overnight. So how do you get around that? I'm just going over the differences in the sessions here. So now I'm looking at the Euro session in black, day session in white. This is the Euro session. This is the complete overnight. It's basically the Asian session. Asian session, I think, starts about 7 p.m. my time, 7:30. So I'm just going over the seasonality here, right? High volume at the open, high volume at the close, a lull for lunch. But now look at here. What's happening right there? That's out of the ordinary. It's a huge amount of volume right in the middle of the day where you should expect lower volume. Well, that's because you've got what we would call very high relative volume at that major turning point. And that's what we're doing with this. We're looking at each individual time frame for each individual bar, and we're comparing the average volume per that time period, per each bar's time period, to the volume that transpired during that particular bar for every single particular bar that you see. So we're comparing each bar's volume to the average volume for that particular time period. And for a 15-minute chart, we may be looking back 20 days. For a 5-minute chart, maybe we're looking back 12 days. So it just kind of depends on how many days you want to have to import to the chart. But just real quick, in the future, we'll have a relative volume manager where you'll just be able to have to run these calculations because they are kind of heavy calculations, especially for tick-based charts. We'll have a centralized hub for each market that you want to analyze. We'll do all the calculations in one spot for each market, and then each chart's indicator will simply access that pre-calculated data rather than having to run the same calculations for each and every single chart. It'll just be 2 calculations per market. All right, so that's what we're doing with the relative volume, and then taking it a step further, and I could talk about a number of guys that have worked in volume analysis. I'll come back to that in a moment and make sure that I mention them because they deserve some credit, because I'm coming after them. I've read everything that they've written. I've read everything that I've been able to find on volume, literally everything that I know of. And the men that I'll mention have done the most work that I've found to be the most logical and useful. But then we take it a step further and we're doing the same thing with range. Okay, and then we're looking at the relative volume relative to the range of the bar. So if you have a very high relative volume, wide ranging bar, well, then that's a climax bar. And you can see you've got a climax bar here that kicks off the beginning of that massive move down. But then you also have another climax bar there that happens to be a doji. So you know the volume is starting to shift, right? Closed off of its high and it closed off of its low. So you know there's a fight going on there at least. It happened to be the actual turning point of that swing. Same thing here. Well, it's not the same as that, but I'm saying you have another climax bar here, very high relative volume, wide ranging bar, turn. Here, relative to the preceding bars and relative to the ranges of those preceding bars, you have another high relative volume, wide ranging bar, turning point. This is the beginning of a turning point, and this is the next major pattern that we look for, which is called volume divergence. And that's what I think you guys will really find to be very incredible. Now, I talked about the climax bar, so I have to mention churn. Churn is the case that I described initially, where I was talking about, you're moving straight up into a high, and then all of a sudden you get a massive amount of volume that comes in, and yet the range of the bar is smaller, even tiny, relative to the previous 5 or 10 bars. So what does that mean? Well, it's something that Barry Taylor, he coined the term or the phrase churn bar. It's churning, and that's the best way to describe it. So I use the same name. Churn basically means very high volume per range. Okay, so the volume is so high that, well, let me just put it like this. When you divide the volume by the actual range of the bar, the true range of the bar, right? Not the relative range, but the true range. When you divide a very high volume bar by a very narrow ranging bar, that is the input for what we call the churn bar. Okay, that's a high density bar. So we call very high volume per range. We call it very high density. Okay, so a churn bar has to have high density, but a high density bar does not have to be a churn bar. You can actually have a high density climax. Yes. And then this is one of my favorite patterns here. So this is just a 10-minute chart where I have relative volume on here. And these are the signals that are produced from the relative volume. Whereas if you put raw volume on here, it's meaningless. This is what's called a two-bar pattern. So we have a big buying climax followed by a churn bar. All right, it's actually a high density buying climax followed by a churn bar, meaning that you have a very, very high relative volume, wide ranging bar. All right, you don't necessarily want to sell into that bar. You'd prefer to see it slow down, right? You want to see that next bar have a narrower range with a relatively similar amount of volume. Because why? What would that signify right here? Here you've got a huge amount of volume and the market moved a relatively huge distance. Here you've got maybe 20% less volume, but the market moved about 52% less, about 55% less distance. What does that mean? That means you've got at least 30% more supply coming in on that narrow ranging bar than you had on the previous bar, which means what? Which means it's finally reached supply, right? It's all very logical stuff, but it takes a minute. It takes time to really grasp this. It's all very logical. It makes, really good sense. But when you're seeing this stuff for the first time, or, even after you've been working with it for a little while, you almost have to talk to yourself when you're doing this, or just listen to me, describe it in the training sessions. But that's really what this is all about. We're looking for identifying major areas of supply at highs and major areas of demand at lows. So right here, you have another two-bar pattern, but this is what we call an extreme churn two-bar pattern. So the fact that it's that hot pinkish reddish color, which we're actually using black charts now, which look a lot better in my opinion. Although this looks pretty clean. At any rate, that's an exceptionally high amount of supply that's coming into the market there. And then of course it goes straight down after that. So this is what you want to see at the exact area that you're looking to trade. And if you don't see any of these volume signals at those areas, and that's when we have to talk about on which charts relative to which chart is your operative time frame. If you don't see these signals, then you don't want to take the trade. Why? Because there's a lower probability of it actually moving in your favor. And when you're trading like this and you're not actually waiting for the market to turn in your favor, it can be a double-edged sword, but overall, according to my results, you can narrow you can limit your risk by so much compared to the amount that you can potentially make on the trade. And this is all defined by the market geometry, how much you're going to risk and how much you're going to potentially make. It's all clearly defined for you using the channels and the median lines. You can, easily get realized 3-1. I'm talking realized when you factor in all of your losing trades with your winning trades. You can get a realized 2.5 to 3-1 R multiple on your overall track record. Now, maybe I shouldn't say things like that. Take that with a grain of salt. I'm not showing you any results here. I'm not talking about back tests. I'm not saying that you can now go out and do that. But I'm saying trading like this has been the only way that I've been able to do that. Okay. It's not going to be easy for you. It's quite difficult to learn. But anyone who ever told you keep it simple, stupid, KISS method, in my opinion, they don't know what they're talking about, because it's not simple. It's quite difficult, and it's much harder than you can possibly imagine. And everybody's wanting to simplify, simplify, simplify. I feel you. I know. Yeah, I want to simplify too. Yeah, every day. But every time I do, I end up doing worse. So fact of the matter is, it's not a simple thing, and it may not necessarily have to be, you may not necessarily have to have as many charts as I use to do it effectively enough. But the way that we use them now, together with Shark Indicators, Bloodhound, and Blackbird, we're able to automate some of these signals coming together to do some of the heavy lifting for us. And to automate some of these different, signals from the different indicators, but we're also able to access programmatically all the areas produced by the toolbar, which includes the volume profile, and produce signals from all of those combined charts, such that when it all comes together, we use Bloodhound to paint this bright green stripe for potential longs and bright red stripe for potential shorts. So that's what I want to get into a little bit on Saturday. We're going to go over trade after trade after trade, and I think it'll be well worth your time. Yeah. So let me at least mention these guys real quick, because if it wasn't for them, I wouldn't have been able to produce the volume analyst as we did. This is Brett Steenbarger. He actually worked for Mr. Paul Tudor Jones. He worked for his firm for a number of years, I think from like 2010 to 2014 or something like that. But he's a psychologist or psychiatrist, or both. But at any rate, he's working for Mr. Bellafiore now, SMB Capital. They put together a pretty great course from what I understand as well. But he's a brilliant man. He wrote an article, I think back in 2010, about how to identify when you might have more probability of there being high volatility within a certain day in a given market. So like, for instance, for the ES, if you had very high volume all throughout the pre-market session, and then a very high volume open relative to the previous sessions, then the odds of having a very high volatility day are greatly increased. Okay, and everything that we do is based on odds and probabilities. We may not, you may not be able to nail down exactly what those odds and probabilities are, but if you can consistently make yourself think in terms of probabilities, which there's really no other way than to fully understand statistics, which, oh Lord, I hated that, learning that stuff. But anyway, once you can think like that consistently, then it kind of becomes, second nature. But you have to do the work that's involved to get to that point, and it's a lot of work. So anyway, he did that with the idea of relative volume. So they were looking at the amount of volume, like I said, that transacted up into the open, and then at the open for the first, let's say, 5 minutes. And they compared that to the average pre-market volume for the past, whatever, 10, 20 days. And the opening 5-minute or 10-minute volume for the same, the past 10 or 15 days, 10 or 20 days. They were able to determine when they should more likely put on their day trading type strategies and take advantage of the higher volatility days, and when they should pull those off and only focus on, their swing trades, which maybe that's 2 to 5 days or 2 to 5 weeks. That's where the idea came from for the relative volume. And then I wanted to take it one step further, and I wanted to do, having read his article, I wanted to do, like I showed you, take each individual 5-minute candle, if I'm on a 5-minute chart, and compare that current bar's volume to the average volume per that time period. Okay. I just so happened to find a guy that had done that. So I worked with him and had him tweak it to my specs and then add in all the different, relative to the bar's range. Is it high volume, wide ranging bar? Is it high volume, narrow ranging bar? So we did that. Fine. Okay. Was it useful? Yeah, very much. Which charts could we do it on? Only minute charts. Only minute charts, because it's a time-based calculation. So if we wanted to do that on a tick-based chart, what would we have to do? Well, a very, very elaborate algorithm to be able to look at each individual bar's millisecond timestamp for the close, and then the projected likely timestamp value or duration of each individual bar that's building in real time, to have some sort of way to build that signal in real time. But then when that bar closes and we have the exact time period that made up that bar, then to be able to immediately at the very first tick open of the next bar, calculate the exact right values for that previous bar, so that we could still get, the real-time intra-bar signals, but make 100% sure that when that bar closed, we also got the true, not projected values for that particular bar, for each individual bar that builds in real time. All right, because we want to continue to get the signals in real time. You don't want to have to wait for the bar to close. And that's what's key about divergence analysis. You have to be able to get the data in real time. Anytime you're working with multiple time frames, if you're waiting on those higher time frame bars to close, well, you can do all the back tests that you want. They're not going to look anything like the way it's going to look in real time. Okay. If you are waiting for the higher time frame bars to close, well, then yeah, you could make the back test look like it would in real time, because you're always waiting for the higher time frame bars to close. But if you're using an hourly bar and a 4-hour bar, and you're waiting for that bar to close, that means you have a 4-hour fudge factor window where maybe you could have gotten in closer to the end of the swing within that 4-hour period. Maybe it was only 5 minutes after that 4-hour bar opened that you could have gotten in when all the signals would have occurred in real time. But instead you're, just randomly based on whatsoever happens to be the exact period for that chart, that bar, that's governing when you can enter and exit a trade. Well, that's just idiotic. It's stupid. And it's a waste of time, and it's a waste of ticks. And anytime you can save even a tick or two per trade, I mean, even futures trader 71, I can't remember his name, but he runs stage 5 trading or Vancar. It's on the tip of my tongue. I can't think of his name, but he used to have a prop shop, and he would say, look, my best traders, they only had an expectancy of 1.5 to 2.2 ticks. Anything above 2.5 ticks was considered exceptionally amazing. So think about that. They made money where on average, their winning trades on average would be no more than 2 ticks per trade. Let that sink in. So that means that, they might make, maybe they're looking for little just rotations, which whatever the volatility is for the day, maybe it's 12 ticks or 20 ticks or whatever. So their winning trades are maybe 20, 15 ticks. Their losing trades are probably, I don't know, half of that, hopefully, or maybe the same, maybe exactly the same. I don't know. But after all the calculations have been done, they're only ahead on a trade by trade basis by 1 or 2 ticks. So imagine if you can just save 1 or 2 ticks per trade, per every single trade. What if you can do that consistently? How can you do that consistently? Well, one thing you can do is you can start getting in closer to where the likely exact turning point will be. How do you do that? Well, you isolate all of the telltale signs of what those turning points are. What do they look like? What are the recurring patterns that you see at these turning points? How do you do that? You have to mark up a ton of charts. You have to do a lot of work, and you have to have inputs, data inputs that are actually useful. What are those? Volume, relative volume, especially relative volume on tick-based charts. This is a bar that I created here. It's called the row bars. It's a really arrogant name for it, but I was convinced to call it that, so I did. It's a hybrid of range, ticks, and seconds. So I can set a minimum value for each and a maximum value for each. So each bar has to be a minimum number of ticks or volume. Well, we'll have a version that you can do ticks or volume, but for now it's minimum number of ticks, minimum range of the bar. It has to be at least, in this case, 1, which means 2 ticks, a high and a low at different prices. Minimum ticks is 310. Minimum number of seconds that must transpire within each bar is 30. And the maximum is that last number on the far right end times the preceding value. So if this is 306, that means 6 times 30 seconds is the maximum number of seconds each bar can possibly transpire, can take up. Okay, so I've got really elaborate minimum and maximum rules for these bars, such that you could really create any type of bar that you could possibly think of with this. And I made these specifically for the volume because I wanted to display that volume data in the best way that made the most sense. And minute data has its own nuances and benefits. Tick data has its own nuances and benefits. I mean, you have a fixed number of ticks that each bar will have. So looking at raw volume per tick gives you another data point to look at when it comes to volume. But with these, I wanted a very particular look. I wanted to be able to get that look from the tick charts, but also when we had a huge amount of volume come in, that climactic type stopping volume, I wanted the bar to be able to build into a wide-ranging high volume bar. And it's really through the use of these bars that the volume signals are just really heavily accentuated. It's not something we can get from the tick charts, and it's not something we can get from the minute charts. It's something we can only get using this hybrid chart. And yeah, it's whatever. I'm not going to toot my own horn, but it's, for me, with the volume, it displays it in such a way that's the most beneficial. So, and this is the relative volume here on a 30-minute candle. You can see the raw volume below it, which is essentially useless. I mean, you could lie to yourself and say that it isn't, but it basically is. And this is one of the patterns that we look for, which is called volume divergence. Guys, I could go on for the next 120 hours straight probably, but I'm not going to do that to you. Here are some other volume divergence signals here. This one starts with a 2-bar pattern and then ends with a little baby climax. So yeah, when it comes to confirming the areas where we want to do business, this relative volume for the tick-based charts, just there's nothing that can hold a candle to it. So let me see if I have lost on my crude short. You want to go over a trade real quick that I took today? Briefly. All right. I can't help myself. I had to take one. I guess I'm the epitome of informal, which maybe someday I'll have to grow up and do something about that. But for today, if you'll bear with me, can you give me like 2 minutes? Let's just take a little bio break, as it were. And we'll meet back here in 3.76 minutes. And then I'll go over this trade here. Sorry, I don't know when that went on mute. Oh, I see what's going on. Huh. My hotkeys are all turned around. I'll be. All right, well, yeah, this is the one I'm talking about right here. I got into it a little bit early here. But anyway, whatever. Yeah, it's short. I think it's going to go down to a new low. I'm not 100% convinced about that because of what it's turned up from today. Excuse me, exactly what it turned up from the other day here, the midpoint of this upsloping channel. But we can go over that real quick. I think the key to learning this is, and that's why I did what I did with that analysis live service, so that I could actually export all of my analysis directly to you guys' charts. Most of you guys that have been with us for a while won't need that, but for someone that's just getting going good, I think it's going to be pretty key. Somebody accused me of just doing all this to make money. I'm actually not going to be, it's going to be a part of the trading room. So it's not like I'm not making big bucks here. I'm barely staying afloat, actually. But yeah, at any rate, I'm doing this to help you guys learn it, because everybody was complaining that I do it too fast in the trading room and they can't keep up, So I felt bad, and I wanted to, make it to where you guys could have it instantly and not have to kind of fumble around and, by the time you're caught up, well, then you're already behind again. So anyway, I think it's a good learning tool. We'll go over all that on Saturday, but it should be a game changer. If this was available when I was first learning all this, I'd have paid probably 10 times what I'm going to be offering it for. So anyway, give me 4 minutes and then we'll come back and go over this trade here. Yeah, Analysis Live is only available to Master Suite owners as part of the trading room. But we're going to have that 100% ironed out for Saturday, because the details are still a little confusing even to me, and I'm the one that wrote them, so that's saying something. But we are going to make it to where anyone that just has the toolbar will be able to sign up for it, but it'll obviously cost more if you only have the toolbar, because everyone else had to invest in the entire suite. So let me give you guys the link for Saturday. We'll email it out as well, but let me do that so you guys have it. So that's going to be for Saturday at 2 p.m. Eastern. And here is our products page and the coupon code for 25% off, which I don't think we'll ever go that low. Well, we're going to be kind of changing our pricing after the first of the year and make it, the amount of time and money that we've invested in development and modifying and updating and upgrading, and it makes more sense as a kind of similar package to like what Shark Indicators does, the yearly maintenance fee. We'll still have the ability to sign up for life, but if you don't have any income, it's kind of hard to stay alive. I don't exactly do a lot of marketing for good reason, because I don't want that many people to have all this stuff, obviously. Otherwise, I'd be doing webinars every week if I wanted to make millions off of this. Who wouldn't? Not me. All right, I'll be back shortly. 4 minutes. Okay. I'm going to answer all of your questions here in a moment. Let's just quickly go over this. So, well, let's just start with this one. So, you'll always hear me talk about in the room connecting from the low before the high or the high before the low as a starting point, right? In this case, you have 3 possible swings to the left of the ultimate high, right? And then the other thing that you'll hear me say is connecting from the penultimate high to the ultimate high, which would be this one. Just look how fast I can do all this with this toolbar. It's insane. So just starting from scratch here. So I've got, that's really the penultimate high to the ultimate high. We'd already broken down through that. I was looking at the retracement back up. I am on the right chart, aren't I? Tick 2. Yeah. Anytime I'm recording, I can't tell because they don't have that outline. So yeah, if that median line, upper median line, is downsloping, well, then I look for if we've turned down from an area, which we had, then I'm looking for a retracement back to that median line. So we had one here, and then it turned down with a quickness. And then I'm looking for it to pull back into it again, in this case, in line with that kiss goodbye line. So this is the parallel, this is the channel. And we pulled back into it here and almost tagged that median line. And that's where I first got short my first 2 right here. And then I added another at the high there. And then I had another one literally 1 tick above the high, which didn't get, didn't get filled. So I waited for volume divergence on the faster chart. So let's go over that. What's the operative time frame for this trade? let's see, I restarted. So we have what's called a reader system. So I have all these different charts. Pardon me. I have multiple different charts. I have 2 tick charts, a 2-minute, a 5-minute, a 15-minute. The first tick chart is the relative size of the 2-minute chart, and I use our time frame tuner to determine what the tick value of that will be. So this is a little instrument that we made to determine what tick size the chart needs to be, and we used to update it every 2 weeks. Now we're updating it about once a month. But now that we have a lot of the development done, I'll be doing that probably every week or 2. But anyhow, so we had a pretty quick down move here and then a retracement up. So I'm looking for a short. I want to catch that next move down. I'm thinking we'll have, at least one move down below this low, probably below this low. So I'm thinking we'll make 57 by the end of the night. Well, yeah, by the end of the night, maybe the morning, unless it fails. Of course, it could easily fail and just go back up. But this is what I'm expecting to happen. And I think there's a fairly good probability of that happening from this area. So that's why I took the trade from this area, but I had to wait for confirmation, right? So how do I determine what the confirmation will be and from which charts they'll be getting those confirmation signals? Which charts do I need the confirmation signals on? So these Bloodhound templates help me determine which trade or which chart I'm identifying as the operative time frame for the particular trade. Okay, so at this high, where I got into the second order set, which was the third contract, I got into the first 2 here, which made it a setup on the 5-minute. I'll show you that in a moment. But the second order set is showing as both the 5-minute and the 15-minute. So because the first order set was on the 15, or sorry, on the 5, let me show you. And I had a couple of choices to pick here. It automatically chooses this high because that's the widest swing point perpendicular to this baseline. But let me show you on the 5. So this was the actual operative time frame for the trade, as I have my potential short here. So essentially I can only take a short from this 5-minute chart if I have the short signals from this Bloodhound template, which is made up of multiple different solvers connected to the swing algorithm that's built into this divergence analyst indicator. Okay, so to be able to find the divergence between the different swing points and bars, I have a really elaborate swing algorithm looking for minor, intermediate, and major swing points. And we have something like 90 different data series that make up this indicator, all of which we can access for different purposes. And just to give you an idea, these are the different data series that I've had built into this. It's pretty elaborate. It's not 90, it's I think 45 actually. So pretty elaborate group or set of conditions, multiple condition sets to identify which chart is the operative time frame. I've identified that as the 5-minute chart here. And therefore, I need to use the subsequently faster charts to confirm the area using the volume and the momentum divergence. So that means I need confirmation from the 2-minute and the faster tick chart, and then the row bars. So I needed to wait for, didn't necessarily have to have volume divergence, but I waited for it anyway on the 2 minute, which means we had that really high volume here, that buying climax, and then we get this sign of weakness, and then it comes back up, breaks that prior high on much lower volume. All right, indicating to me that the buying is starting to dry up. There's a more likely chance of it actually turning down now. Okay. So that's what I'm looking for. Preferably, it doesn't have to happen in certain cases, but in this case, I wanted to wait for it. So I did. We also had the churn bar there, which means that we've run into resistance, and that's where I initiated the first 2 contracts short right there. Okay, and at the time, I had dragged this back to the highest high. So it didn't quite line up as perfect there on the 2 minute as it did on the tick chart. On the tick chart, it was lining up perfectly. So I had the downsloping areas in favor of the trade, but I also needed an upsloping area. And we did actually have that on the 5 minute. So I know this is getting a little convoluted and complex, but that's why we have all of this built out into Bloodhound templates. So this is connecting that major low here to the ultimate low. And then we've got that median line, right? So I wanted to wait for price to get back to that median line and then start rejecting down from it after I'm in the trade, hopefully not before. And then my risk to reward is potentially much, much greater. The stop on this one is really larger than technically I should have had, but I wanted to give it room because that area downsloping on the 15 minute was still a little bit further away. So I wanted my stop behind that. And I want to have my stop behind an area that could potentially protect the trade. Okay. So that's rule number 1 for the stop placement. It needs to be behind an area that can potentially act as support for a long or resistance for a short. And that's really what market geometry is all about. It's support and resistance. It's supply and demand. There's supply and demand lines. Despite what people would tell you that, supply and demand is just literally looking at the exact price where you had a swing low. Well, then if you come back down to that price, you're going to have demand. Well, that's just ridiculous. Within an uptrend and you get these little retracement lows, yes, if you get another retracement low back into one of those, then you are fairly likely to have another swing low there because it, in most cases, is a 4th wave low. And the 4th wave tends to end at the previous 4th wave of one lesser degree. So that makes logical sense when you have it all within the framework or the context of the Elliott wave theory. But in general, yeah, you're not going to have major supply and demand come in at previous major turning points. It's just not the way the markets work. Future supply and demand will be a function of those previous areas where you had major turning points. Okay, that's how you project supply and demand, where the likely next area of supply and demand will be. Does that make sense? Because that's really what it's all about. That's what market geometry is all about, projecting where those next major areas of supply and demand will come in. All right, so then just real quick, and then I'll take your questions and we'll call it a day here finally. I'm in desperate need of that. Let's see. Not as bad as I have been in the past, though. At least I wasn't up all night. I'm usually more focused on getting the software fixed. It's like I'm always testing and, you know, listing out bugs and working with a fix and trying to get everything working right. Much more worried about that than I am having a good solid presentation. I know it should be well, maybe it shouldn't be. In my mind, it shouldn't be. In my mind, people that already own the software should come first. And I know it doesn't always feel like that, but believe me, that's my number one priority before doing presentations. But I guess that's my excuse for not having the best presentations. But at any rate, this is the main chart that I took the trade from. So here, let me just delete everything. That dashed blue line is the midpoint of the day, the session median. So it's just the high plus the low divided by 2 of the day. Hang on, I'm just recalculating everything real quick. All right, so if I'm looking at the low before the high to the ultimate low, well, that's the low at the previous session close right here. So I connected from that to the ultimate low. And then actually I dragged it back to the highest high between those two. And that's where I first got short. Right here, actually. Yep. And then I added one more right there. And then I tried to add another one, as you can see, one tick higher. And now it's finally turning down. So I'll tighten these up. And I restarted my computer before I did the presentation just to make sure nothing would go wrong. So I'm missing one stop. Yep, so now I've got all 3 in place. It's really no sense to lose on this at this point, but I don't want to tighten it up too fast, too soon. Too far, too fast, I mean. Let's see, 41. And then I'm literally putting my targets on the next major areas, which on the 15-minute is at 41. And then here on this tick chart is at 49. I don't know how many of you guys are left. I guess, not sure how many we had in here, 114. So probably about 85% of you are left. For those of you that already own the toolbar, this is what we're currently working on. So being that we have so many charts, we wanted to make a window manager where you could shuffle the charts around and then save a particular layout and then shuffle them around again, save another layout to another button, and then be able to click on that button or use a hotkey, which I'll use a hotkey, to shuffle the previously saved layout, bring that back into focus, and then use another hotkey to bring the other one back into focus. So yeah, maybe there's a lot of charts and it's 8, 11 charts per market, but with this new functionality here, if you just had one screen, you could put 4 charts per that screen, save it, do the other 4 charts, save that, do any other combination of different charts. You can even combine all the different charts from multiple different workspaces you have open. You can bring all of those charts into one workspace, and then when you're done, you can separate them back out. So we've fully gotten into the way workspaces are handled, and we can combine them, separate them out again, save different layouts. It's It's really pretty awesome. I'm going to do this and it's probably going to crash, but let me just try it anyway. See what happens. It is prototype. All right, so this is one button. I'll add another one. Window manager. All right, so that's 3 different layouts I can save. So when I get it set up the way that I want it, let's say that I'll put these 2 for this button. And then I'll bring a different one for button number 2. So you just open it up and then click this to save it. And that'll be button number 3. All right, cross your fingers. So now I'll click button number 1. Boom. See that? Button number 2. I don't remember saving it quite like that. Button number 3. That's right. Number 1, that's right. Oh, he did tell me there's still something weird with fully maximized windows. So that might be what I'm seeing right there. But yeah, I think in 3-4 days, we'll have it all worked out and release it. So this was the final piece of the puzzle for managing multiple charts from multiple different instruments, all on the same workspace, and just using hotkeys to shuffle the charts around. So you can always have at least 1 or 2 charts of every instrument showing at all times. Isn't that cool? Finally have it, guys. We've been talking about this for like a year. There we go. Now it's, yep, look at that. Isn't that cool? And it's about what, 30 or 40 times faster than flipping workspaces. Pretty cool, man. This is my it's the favorite thing, my favorite thing that we've done in a long time. This is what I've been waiting for a long time. So hopefully we'll have it out in the next week, maybe sooner. All right, let's take some questions then. Yeah, it's cool, isn't it? That's it's going to make using multiple time frames for multiple instruments actually doable. And then you guys haven't even seen the import. Well, you know, for those of you that are new, haven't seen the import manager and the reader manager, how we make possible the importing, exporting of all the objects, and then the strategies. We'll get into that on Saturday. It's been a while since I've done an actual webinar. We're going to get back into doing the weekly training sessions too, now that we have all the big stuff done. I'm just going to start updating the guides now, finally. And then we're going to start doing the weekly training sessions again. All right, I'm just going to start from about 5 o'clock. Goodness gracious, I might have. Yeah, I'm going to start at 5 o'clock Central Time. I'll go back to 4:30. And if you wrote anything before that, just put it back in for me, please. Are alerts available to bring areas time? Come about wires. Yeah. So the alert system is pretty incredible. We have, we're actually going to make this an alert manager at some point for any indicator, but that'll probably be like the end of spring of next year. But for now, for any of the toolbar objects, for most of the toolbar objects, I think the only one we can't do is like the rectangle. which would be like this. I don't think you can put an alert on that. No. If you can put an alert on it, it'll highlight when you click the alert or the hotkey for the alert and then hover over it. So like a horizontal line, yeah, you can apply an alert and see how it looks kind of fuzzy. So that's when you know you have an alert active. For some reason, he had trouble with making them persistent when you restart the platform. Although they still show as being active, they're not. And he knows how to fix it. We've just had so many other things with, trying to make it 100% stable so it doesn't freeze for anyone anymore. And even with all that, it was still only some people experienced all that freezing. Some people never experienced it. Others experienced it only once out of every 20 startups. I was one of the lucky ones that experienced it just about every day. It drove me almost insane. But yeah, we were focused on that. So now that we're done with that, he's going to go back and fix all these. Well, there aren't that many, but stuff like this to make the alerts persistent. So in Ninja 7, you can set an alert and then restart the platform. If it wasn't touched, then it'll be active again. So we have proximity, crossover, and then you have a tick threshold. We're going to add an average percentage of the average range into this. I don't know why we haven't done that yet. We have it for literally everything else. Recurrence, one time, or recurrent, meaning that, if it hits it, it'll go off just once. If it's recurrent, then it'll hit it, go off, and then stay active. And then if it comes back to the underside of it, it'll go off again. You can set the direction. You can make it automatic. One-way automatic, like if it's below current price, it must come down to touch it to go off. There's multiple options there. You can set Ninja Traders alert, which is actually the alert window, the Ninja alert window, which is right here. That's what this is, the alerts window. And then pop-up enabled. This functions as the alarm bell. Well, that and email. So you can set an email alert, and there are some text services or email services where you can have particular emails be sent as a text also. But this one will get you up out of bed if you have it, set loud enough and don't have a timer. So that's 5 seconds. You could set that to 500 seconds, and then somebody's going to get up, depending upon how loud your speakers are. Yeah. And then to make it go off, you could set it to 5,000 seconds, and then the only way you're going to make it go off is if you close that pop-up timer. So let me just show you. There you go. So this is the pop-up timer. It pops up underneath your cursor. You see it? And then if it's on another workspace, it has a button there to flip. And if you click the button, it'll flip to that other workspace. And then we had it before, but we removed it because we had a bug with it, but we've since figured out what that bug was. We made it flash the chart a particular color. So we're going to add that back because the other indicators have it, like the volume analyst has it. It'll flash the chart red when the alert goes off. It was a long time on one question. Let's see. For corrective waves, are you drawing the baseline over the highs when downsloping by default? Yeah, I'm doing both actually. Typically though, if it's, well, let me see if I have an example real quick. I don't want to spend too much on just one question, but it's a good one. And you see how these little groups snap to the toolbar so they can be independent You can just double click on them and hide them, or you can make them snap to the main parent toolbar. So this is the parent toolbar. And then, yeah, so you can set it up however you want it. Fully customizable. And then the market geometry, you can make it look literally however you want. See, Ninja draws these windows kind of weird sometimes. Hang on. Okay. Yeah, so for this one here, first of all, I'd be looking for where the upsloping one would want to come in, would potentially come in. This is the most obvious high to me to connect to, right? High before the low. Okay, I might be tempted to connect to that one too, but first it would be this one. And then when we start turning down again, I guess it's already over there. Yeah. Okay. So we didn't even meet the bottom of that. But then I would also draw it on the tick chart. And that's why we use both tick and minute, because sometimes it lines up perfectly on one and not the other one, and vice versa. So in this case, remember when I said when it's not likely to make it to the opposite end of the channel, where you've got something else coming in before that? Maybe it's a really sharp A wave down, which this is, and then the C wave is just kind of slow to down, and you have a kind of a shallow retracement for the B wave. A lot of times I'll use that lower high as well, or the preceding high. Depends on which one's closer to the main high. In this case, it would be this one. So I would want to connect to that one as well, because this is so steep straight down here. So I would connect to both of those like that, and then drag this to the lowest low. Well, yeah, then it lines up, doesn't it? But there are these little nuances that you have to keep in mind. Yeah, then it comes down to the exact tick. But if you did that here, see how much steeper this one is sloping down? So that's fairly steep because of this fast A wave down. So that's when you use the midline. And here you just throw it over slightly by about 5 ticks, 6 ticks, something like that. But yeah, if there are swings from low to low that would line up at a potentially slightly different spot than where the bottom of either of these channels would line up, then I would draw that one as well. Like maybe I would draw from low to low and look for an upsloping or slightly downsloping lower median line. But you don't get any of that in this example. So yeah, if it calls for it, then I'll draw both, but it's usually one or the other. So there are some nuances, but you know, it's like anything. You gotta get the hang of it, get used to it. Yeah, I'm gonna send out the recording 6:30, 8 o'clock probably. I gotta render it and then add the bumpers and then upload it. So yeah, it'll go out about 8 o'clock. Yeah, that's what I used to use them for, the alerts, but to wake me up. But yeah, I I basically just quit sleeping. So I'm just kidding. I tried that for a few months and then it just about killed me. So I'm not doing that anymore. I literally, the first time in a few months, I did an all-nighter, uh, having to get NinjaTrader this presentation, which needs to be 30 minutes, and it took me what, 2 hours. So I need to get this down to 30 minutes. I had to get them that presentation Sunday, and I ended up pulling an all-nighter, and it just about killed me. I'm not 30 anymore. I feel like I'm about 130. Doesn't take long to do damage to yourself when you're staying up like that. I didn't feel it at the time. I mean, it didn't feel, anyway, whatever. Best and most consistent rule for Elliott is if wave 2 is a simple pattern, then 4 will be complex. Yeah, exactly. Mm-hmm. Or if 2 is really sharp, 4 will be sideways. Yeah, and vice versa. Am I planning on incorporating automatic Elliott waves? Not into the toolbar. I don't know. So many people have attempted that, and it's all so totally mediocre. I'm going to do something. Um, it won't be. It won't do both the trending impulse waves and the corrections. You'll basically choose the starting point, and then from there, it'll it'll identify whether it's more likely, going into the next correction or uh, the trend. So yeah, I've got some specs written out, not thoroughly, but I know what I want to do and what it needs to do. It's got to be pretty elaborate to do it properly. It's like the hardest type of thing to program, to do it right anyway. Yeah, we're going to go over all that on Saturday, Raymond, the analysis live. Um, Basically, anybody that owns the toolbar will be able to sign up for it. And you won't necessarily have to be in the trading room to use it. So we're going to go over all that on Saturday. Yeah, and you guys will have the recording here shortly. What's up, Bobby? Yeah, long's better than shorts, definitely in this market. Yeah. In the ES. Screaming indicator. Do I have a screaming indicator? Mm-hmm. I can make these scream at you. What were the big breakthroughs? The difference between asynchronous and synchronous. So it all has to do with the UI thread and the data thread. And there's a lot of, I guess, some of that stuff they've documented about. That's where a lot of the deadlocks come from, is when you're trying to access the data thread from the UI thread, which is trying to access the UI thread from the data thread, which is accessing the data thread from the UI thread, and so on and so forth. And it gets into a deadlock. So you're waiting on the UI thread to get the data from it to be able to do the calculations from the data thread. It's I don't know. The UI thread is just a little bit problematic in Ninja 8. But what we were having to do required, so it requires the data from both, but what he was able to do was offload some of what he had on the data thread directly to the UI thread without bogging it down. We did that once before, but then it took forever to start up. So now we've been able to do that, but postpone the starting of the toolbar until all the charts have finished loading, if that makes any sense. So now when you start up, you'll see a little pop-up window that says, please wait until the charts finish loading before starting the toolbar. And then you've got a little green button there to start the toolbar, but preferably only after all the charts have finished loading. So, well, yeah, and then the next version that he's writing now, it won't even matter. I think he's just going to make it fully automatic, and you don't even have that pop-up message anymore. So the next version, it won't matter if the toolbar starts up at the same time or not. So it was not that, it wasn't a lack of understanding of how it all works and how the multi-threading works. It was that what we needed, according to, you know, how it was described and whatever, we had to come up with a workaround, kind of a hack solution to make it work before, whereas now we've just completely redesigned the entire approach, and the new approach is just literally 20 times more efficient. So it's like any code could be written 5 different ways, and there's always one of those that's going to be better than the others, you know? It's basically what it boils down to. Like you could have 5 programmers program something. They'll all do it 5 different ways, typically, and one of them will be the best. How do I account for, hey, Andrew, how do I account for hidden orders and large traders that are not required to report volume? Well, they are required to report volume, but they do it illegally, right? They don't report it. There's nothing you can do about that. But it doesn't really matter, because what we're looking at with the high volume, I mean, those guys that are doing it off the books, they're not moving the market, if you think about it, right? Anyone who's transacting on the exchange has to report the volume. I mean, the exchange has to report it. But you might have some guys that are doing some side business. What do they call that? Shadow something? But yeah, that's not, you know, technically it's not moving the price, or it's not necessarily affecting the market, because although they're buying and selling the same thing, they're not necessarily participating in the same market that we are. So what we're looking for with the reactions and the volume, I guess you really just kind of have to see over and over how these swing highs and lows look, and then you begin to recognize it in real time. Most major swing highs and lows have a particular look, and they're almost always accompanied with higher volume. The problem is when you get down to the finer granularity, like really fast charts, then the smaller the swing, the less likely you'll have a proper volume signal come in at the end of that swing. So that's why you'll hear me say, it's a little bit too small of a retracement for me to get into. I don't like this because it's a little bit too small. It's because I'm saying that because the odds of getting the right volume signals that I typically need to get into a trade, they're just simply less likely to occur on some of those smaller retracements on smaller charts. But yeah, I mean, there's nothing you can do about people trading outside of the market anyway. I haven't gone into the volume profile, and we don't have time to do it now, but we'll definitely do that on Saturday. Yeah, so the volume profile tool I've got, I don't know which chart I'm on. Is pretty nice. And then you can apply alerts to every single line that this volume profile creates. You can read via strategy, well, via the readers, which you access within Bloodhound or directly on the chart or Blackbird, the products by Shark Indicators. They're all accessible via that reader system that we have from any chart. And again, you can apply alerts to any of those lines, and it will allow you to change the look, the controls, whatever, directly from here. And then you can save it back to the button. It's really pretty nice volume profile we have here. Took a very long time to get this hooked up right for NT8. You have all the developing areas, labels, different types. So there's the VWAP with the profile, just the profile. Different ways of displaying it. You can go left or right. It's different info that you can show there. And yeah, you can show just the VWAP, just the profile, or both. It's a pretty nice one. It's super fast. And again, all accessible from that reader system. I'm going to be missing a number of these questions, I'm afraid. No, I've got 8.14. This one's not released. Yeah, this is the one that has the window manager that is buggy. So this is the very first instance that I've tested with this new window manager. Yeah, you guys will have 8.13, which is still brand new for you. It's got tons and tons and tons of fixes. Yeah, thanks, James. The templates actually didn't change. The workspaces and templates didn't change. I meant to tell Cedric to tell you guys that. So we have not yet updated those, but that will happen before Monday. Just roll over and changing the values of them is all. Values of the tick charts. Will the window manager save window arrangements for the next time you launch? Yes, absolutely. Yep, it'll store it, and you can control which windows are stored. I think I don't think we'll be able to make it store, windows outside of Ninja. It'll only be NinjaTrader windows, but it's still 10 times better than what we have now, which is nothing. So yeah, it has a spot for it, handle other types of windows, but I don't know how that's going to work, if it's going to work at all. But yeah, that's the key to it, is to making it persistent, so that when you start up, it's good to go. And it's pretty cool because I thought we would have to combine all of the workspaces into one workspace. This actually, whatever workspaces you have open, it'll just combine them in that given session, whatever session you're using it in whenever you started it, that session. And then when you're done, you just simply, there's a button in here you click, where is it? To separate the windows back into their own proper workspaces. So you can combine everything into one workspace if you want, but you don't actually have to. Yeah, this is it. Restore workspace windows. That show all windows combines all the workspaces into one for that session. And then restore workspace windows will separate them all back into their original workspace. And reset will, I think all that does is just, if they're out of view on a virtual monitor somewhere, it'll just bring them back into focus, into a visible monitor. Thanks, Richard. The window manager saying, yeah, being unable to attend the live session. Yeah, I've got a new guide for the import manager that'll be out. I was going to say tomorrow, but not tomorrow. It'll be out Friday. And then the Bloodhound templates and Blackbird templates will be out by Monday. The guides, I mean, it's pretty much done. I, for some reason, just have not finished it. I've been working on everything else except that. And then the next one is the Divergence Analyst Guide and the Toolbar Guide. I've got an update for the Volume Analyst Guide as well. Yeah, the Volume Analyst, the fixes for the, it's like random freezing when you start up, or if it's been running for a couple of days, all of a sudden it can just freeze. Seems like some people experience it, some people never do. Those kind of random lockups, deadlocks they call it, will be a thing of the past once he's done with that rewrite, which shouldn't be any more than about 2 weeks. Yeah, I guess I do give a lengthy one. Thanks, Joe. Trade the measured move. No, David Halsey. No, but I think I know what he's referring to. I mean, it's kind of a function of the fib expansion or the fib extension, like what's his name? Can't think of his name. He talks about it using measured moves. But yeah, we do something similar with the fibs, doing like fib confluent zones. Looking at extensions, expansions. So for instance, that's an extension. This is an expansion. That's an expansion. That's an extension. That's an extension. And then I see where we've got any overlap. But, using particular waves, usually there's more than this, but I'm not really seeing much of anything here. And then I've got these wonderful little tools that makes it such a breeze to do. Yeah, good enough. And then, yeah, now that it's going down nicely, I'll draw this one, this down sloping one. And okay, I'm going for right there, bottom of the down sloping channel. I think I'm pretty well going to make it to this up sloping lower median line in line with that midpoint of the channel. Excuse me. So that's, pardon me, that was gross. I think that's fairly certain. Well, nothing is certain, obviously. That's a stupid thing to say, but you know what I mean. Fairly high probability of that happening. And then, yeah, now I've got a little fib confluence zone down here, which is at the bottom of that downsloping channel. So typically the targets are initially defined based on the areas that got you into the trade. And then once you start moving in favor of the trade, well, then you have two, which, you know, then three, but two new swing points to draw from. And then it connects to that third automatically, which provides you with your target. So now I'm looking for pretty much 57 even, which is what I was saying to begin with, that we were likely headed below that 57.21. If this is going to complete a correction to the downside, like if this is all a big, I resized these earlier and I forgot to reload it. Like if this is all a big A, B, and then I'm looking for 5 waves down for C, it's likely to break that A wave at 57.21, probably to 57.20 or 57 even, which would also line up with the bottom of this channel, which comes in at 57.15. So that center median line as well. So I'm going to bring that target up to about 15. I'll say about 14. Yeah, does that make sense? So this is, hopefully this makes sense and is logical to you, as opposed to just having whatever fixed stops and targets, and which is based on what your whatever your your random selection of number of ticks. Well, I suppose most people would base it on something along the lines of rotations or average swing size per the chart that you're looking at. But even still, there's some randomness involved in that. Like, which chart are you going to use? What swing size are you going to use? You know? So there's always a degree of randomness involved in just about everything that we do when it comes to trading. It's just, it's important that you at least understand that, and you can work to try and eliminate some of that randomness. It's not easy. I mean, it's hard to throw out stuff, especially if you've paid a lot of money for it. It's hard to come to terms with that and just give up on something that you paid 10 grand for or whatever from some snake oil salesman. Yeah, order flow is cool. I'm fascinated with it. I've studied it, not as extensively as I would have liked to, but I'm interested more in swing trading, although most of the trades are day trades. Order flow doesn't lend itself as well to swing trading as it does to quick. I guess it can help get you into a move that may last a little bit longer than expected. But from what I've seen and understood, based on the material that I had, it seemed like it was more geared towards short bursts of individual little rotations. like, you know, like trading a 2-minute chart type deal, 1-minute chart, or even faster. I focused on a lot of that type of stuff in the past, and it's just so stressful. It's too stressful for me. I mean, trading is stressful enough as it is. I don't want to limit myself to, and maybe I'm understanding the order flow improperly. I don't believe that I am. I mean, I definitely understand the concept. We're adding in bid ask delta and relative delta, something I'm going to be working on here soon, into the volume analyst. But the granularity, the amount of detail involved in all of that order flow stuff, I think is overkill personally. But, you know, some people use it and swear by it and make money. If you're making money, go for it. Not break even, not just randomly break even. Although, yeah, sometimes I've done that in the past. I typically trail behind an area, and break even right now is too close because it can still come back and tag that trend line and turn back down from it. And I want to give it enough room to do that. I'd rather not lose at this point, but I've found that when I consistently move the stop too fast, yeah, I may save face, which I guess is pretty important during the trading room hours because, you know, you feel like an idiot when you're up 30, 40 ticks and then you lose 10. But overall, my results were better when I just, you know, left it in place, gave it enough room to move around. I mean, sometimes the trades might take an entire day before they get out of that 30, 40 tick range and go on to the, whatever it is, 140, 180 tick target. In this case, it's only about 100 ticks. But it just depends on the average range and the size of the chart and which chart it is and how big the swings are and what strength of trend it's in, what position of the trend it's in. You know, Al Brooks, yeah, thanks, Mark. He's always talking about a measured move. A little too worried about measuring stuff. I'm just kidding. That's all I do, basically. I mean, that's essentially what this is, right? It's measuring the projected future area of supply and demand based on the previous swings. Yeah, it's recorded. I'm going to go ahead and end it there, guys. If y'all have any more questions, shoot me a ring. I'll take calls for the next hour while this is rendering, and then I'm going to put it in YouTube, put it up, upload it to YouTube, and then email out the link. Hey, Don. All right, buddy. Have a good one. Y'all have a great evening. Yeah, you can ask. I feel like such a boob having bought this CPU, but it's literally the tits. So I guess it's right that I feel like a boob. Can't believe I just said that. That was a pretty good one. Let's see. Let me show you real quick. What's the name of that benchmark? Pass mark. It's weird, I guess. It's gone. Anyway, it's what is it? 9980 Intel, 18 core, 36 threads, and it's turbo to 4.5 megahertz, 1.21 gigawatts, And it's typically like 3.0, but with 18 cores and 36 threads, it doesn't have a problem running stuff anymore, which I used to have a big problem with. What am I doing? System. That's not what I'm supposed to do. Where am I supposed to find this information at? There we go. Yeah, Dell Precision 5820, 64 gigs of RAM. Yeah, i9 9980XE. It's 3.0, but it turbos up to 4.5 if it's under a significant load. The turbo is based on the load. Nope. Yeah. So, when I do all those benchmarks, it's 99 percentile for everything, except for 3D graphics. But I'm not, this is a workstation. It's not made for gaming. So I've got, what are they? They are Quadro 2200 something. Let me see. But yeah, it was custom made by Dell, and every one that I've had made by Dell, like this one has a 6-year warranty. Normally they never go above 5, but they gave me 6. Even if I accidentally spill water on it, they'll come out and replace the parts the next day. So I've never had peace of mind like that with a computer. Like, all I've dealt with for the past 2 years has been computer issue after computer issue. Last webinar I had was this time last year with NinjaTrader, and my hard drive failed literally 5 minutes into the presentation. So I said, look, I'm not going through all that again. Time to get a new computer. And I went ahead and bit the bullet and got the best one I could get. I've never had the best one I could get, so I figured I'd do it once. And I think it'll last for, he said it'll run 24 hours a day, 7 days a week for 10 years. Guaranteed to do so for 6. Yeah, I got the little gaming keyboard. It's a Logitech G13, but I got a new one. I haven't quite hooked it up yet, but it just feels much more comfortable. It's the Razer Tartarus. I don't know why they have to name everything after demons or hell or devils. Like, literally everything they name has to do with the underworld. It's kind of funny, but yeah. Anyway, it's called the Razer Tartarus, but it's definitely much more comfortable. It's got a fewer keys. Like this G13 from Logitech, it's got more keys than I can use. And then the mouse that I have, this is the best mouse I've ever had. It's called a Steel Series Rival 500. And I can control just about everything I need to. I can control all the main stuff just with that one mouse. It's got like 13 different keys on it, and they're all perfectly positioned for every one of your fingers. It's not like those crappy ones that have, the rows of keys on the side. Like, it looks like a mini little keyboard on the side. I never could stand those. This one's perfect. Let me just write that in there. It's called the Steel Series Rival 500. It's a little weird to set up the software, the application for the hotkeys, but you just got to read the manual. briefly. I mean, it's just a little bit different than other ones, but it's pretty cool. Just the most comfortable and the easiest to use as far as the hotkeys are concerned. Was it $80? Yeah, probably. It's worth it though. The next best one is by far the Logitech 502. 502. That one is less expensive, almost as good. It has maybe just a few less hotkeys. 9 underworlds. Uh-oh. Yeah, it's weird all these tech companies have all these strangely named things. Kind of makes you wonder where they get their ideas from. Anyway, I'm going to shut it down, guys. You almost cut them off? Thanks, Sergi. Yeah, you too. Happy Thanksgiving, guys. Y'all have a good time with your families tomorrow. Y'all be sure and talk about Trump now. Yeah, I bet there's going to be some interesting days for some people tomorrow. Love them or you hate them, right? All right, y'all have fun tomorrow. I'll talk to you again on Saturday. We'll send out an email Friday about what the deal. Let me just get you the link one more time in case you didn't get it before. Yeah, and then the code and link are the following. There you go. Okay, guys, finally, only, is that like 6 hours? 3.5? Sheesh. All right, finally, y'all have a good one. Talk to you Saturday. Happy Thanksgiving. Yeah, major updates are up right now. And then we'll have the window manager done probably next week, probably the end of next week, because it's a little funky. I don't know how difficult it's going to be to get it ironed out. But yeah, there are major updates up right now. Well, major compared to a month ago. Only just a couple of other little fixes between the one today and last week. But still important fixes. Even less chance of deadlocks. So divergence analyst has that weird draw target, that it adds to the price panel so that it can draw the trend lines on both the price panel and the indicator panel. So that's all 100% completely, fully stable now. And done. And then we have to add that into the volume analyst next week. So, yeah. All right. Y'all have a good one. Oh, yeah, you're right. I added the extra stop, but not the extra target. Thank you. Duh.
Order submitted.
Goodness gracious. If it weren't for you. Thank you so much. All right, I'm out of here. Yeah, I got to go chill. All right, y'all have a good one. Bye, everyone. I'll send this recording out ASAP as soon as I get it done. All right. Bye, y'all.